Okay, folks, I'm Scott Broberg, president of SBR Financial Group. We're going to continue on with our discussion of the federal tax system and, in particular, tax rates. And what I'd like to show you is something that we call the Laffer curve. Okay, the Laffer curve was made famous by the economist from the University of Chicago, whose name is Art Laffer. This was back in the 70s. What this does, though, is it addresses a relationship, and it attempts to summarize or illustrate, illustrate the relationship between tax rates and then how much money, revenue, actually makes it to collected by the government. Okay, so for instance, tax rates, we've looked at this before. You have, say, a 10% tax rate, 15% tax rate, 28% tax rate. You could go up to 81% tax rate, whatever this is. What's this relationship to then how much money, revenue, actually makes it into the Treasury? And we assume, that very basically, that if you raise the rates here, that you will get a corresponding increase in revenue. But what will, as this Laffer curve will show us, that's not always the case. So we want to be able to take a look at that. Let me move on. Now, just want to point out something. This is not a new idea. So, not a new idea. Even though Art Laffer came up with at least what we're going to draw right here, he drew this out in the 1970s, and it became very popular. This is not a new idea. The economists traced this idea as far back as the 14th century. So in the 14th century, there was an an Arab Muslim social philosopher who essentially was addressing the king of Egypt at the time, or the governor of Egypt, and was addressing this idea of taxation. So I point this out because there's the hypersensitivity of taxes inside of a political discussion, and it's all too often too easy to just summarize it as it was invented in the 1970s. Not the case. It's been addressed throughout history, but they can trace it back at least as far back as the 14th century in Arab North Africa, and I'm pretty sure that the current Democrat-Republican divide was not in effect in 14th century Tunisia, where this idea comes from. So I just want to point this out. If you're familiar with this argument, or you get into a discussion later and somebody says, hey, comes from the Reagan administration or something like that, you can point out that no, it's been around for quite some time. That's the only reason I want to bring that up. Okay, so we go back to our assumption that if we go with a higher tax rate, that we would somehow bring more money into the government. So for instance, if let's say that our overall amount of income that was in the U.S., so this is total income, and I know it's not $1,000, but I'm just going to use that number for ease. Total income, right? And we had a 10% tax rate, which means that the government collects $100. Well, we say, well, look, let's just raise that. We can't budget into this. We can't live anymore with $100, so let's just raise the tax rate to 15, and we'll collect $150. So this is the assumption, is that if you move this up right here, that you will get a corresponding increase in revenue. Well, that's the static way of looking at it, but there's also a more dynamic economic way of looking at it that says when you raise tax rates, it actually has an effect on, one, people's behavior, and two, overall economic growth. So if you raise the tax rates and economic growth declines, then you can actually end up bringing less money into the revenue, or you raise the rates to a point where people begin to change their behavior and try to find ways around paying more in taxes. What's the point? If you have an 81% tax rate, you earn the next dollar and you only get to keep 19 cents, there's less motivation to earn that next dollar. Okay. So what we want to do is, they say a picture is worth 1,000 words, so what we're going to do is we're going to draw this out so that you'll have a picture in your mind of what this argument is saying, or this Laffer curve is theorizing. Let's go back to yellow here. Get a different color. Come on. Okay. So down here, we're going to put down our rate of taxation. And then on this axis, we're going to put the amount of revenue into the government. So this is actual dollars collected. We have a certain rate. How much will that translate into actual revenue collected? So the first place that we want to start with this argument is right here at 0. So if we said we're going to put a tax rate of 0, then all of us would immediately recognize how much money is the government going to pull in. Well, actually 0, because 0 tax rate equals $0 going to the government. So that we know if we want money to flow to the government, we can't have a tax rate of 0. Now, what I'd like to do, though, is go all the way over to the other side of this and maximize this, and let's talk about what happens at 100% tax rate. Well, the answer is if you have this spot here at 100%, tax revenue will also be 0. Because if someone said to you, we'll give you a job, we'll pay you, we're going to raise the minimum wage to $100 an hour, and we're going to give you this really easy job, but 100% of your money is taxed. So at the end of the day, when you're done working, you get no benefit to yourself. So even though we raise the minimum wage to $100, all $100 goes back to the federal government. Would anybody take that job? No. We take jobs, and corporations produce things in order to earn money so that we can go live the lifestyle that we want, or better our family, or create wealth, or whatever it is that we do. So if we were living underneath a 100% tax rate, everybody would eventually just stop working. There's no motivation except for survival to get anything done. So we know that on both ends of this spectrum, 0 and 100, that there now lies some curve, okay? And the curve is going to go somewhere, it's going to rise, but at some point we know, since we have to get back to here at 0, that it's also going to fall. So you'll notice at some point, and this is we're not going to be able to figure this out, and this is where everybody debates, at what tax rate does this actually start a decline where less revenue is coming into the government? And what the government wants to do is try to find a way to maximize that. So I'm going to get rid of this right here just so that it's not distracting. Okay, so that's the concept. So we know 0 tax rate produces 0. We know 100 produces 0. So now we start our march up. So we go, okay, let's tax people at 10%. And they find out, okay, well, at 10%, we're going to bring in X amount of dollars to the government. All right, what if we went out to 20%? Well, at 20%, we're going to bring in X amount to the government. We go out to 30%. We know we're going to bring in X amount to the government. And you can do this all the way up the line, right? So you 50%, 75%, 85%, whatever it is. But you know, as revenue is climbing on one side, because we're actually collecting, there's some point in here where we have to get back to this 0. And what we can't figure out, and different, I mean, economists study this, so they'll come up with different theories about it. But so one economist might do something that looks like this, and they say, well, look, we think we can go with a 75% tax rate is the point where things are going to fall off. And then, of course, another economist comes out and he says, no, I disagree. I'm going to say that we've studied it, and you're going to maximize somewhere around 33%, and then you start to fall off. So this is where the debate comes in, but this is the idea. This is what creates your Laffer curve. Okay, is that somewhere in here you get a rise, but then you have to come back and get a fall. Okay, so what we're going to do is end this video right here. We'll do a part 2 to the Laffer curve. I'm Scott Broberg. If you make sure you watch that second video. If you don't get a chance to watch that one, you can find more information at our website, sbrfinancialgroup.com. Okay, we'll see you in the next video.